we're now going to bring in Adnan. And Adnan, I'd like you to tell us a bit about Barings emerging EMEA opportunities, please.
Thanks, James. Good morning, everybody. Thank you for joining me. So I'm going to talk to you about our investment trust here, which is the Emerging EMEA Opportunities, what we call for short BEMO. It's an emerging market investment trust, but it's sorry, I'm just trying to control it here. It's not. It's very specific to emerging markets and is very specific to a region in emerging markets. And we'll talk through what our thought process on emerging markets and the evolution of investing in that asset class. I lead the investment trust. I've been leading it now for the last 4 years, but I've been involved within EMEA for the last 15 years. We're one of the longest running investment teams that are specifically looking at that region. My co-manager, LA, has been with the firm for over 10 years. And there's another individual that we work with, Matthias Siller. And us three have been looking at this region for over 15 years at this point. So when most people, just a bit of history on the asset class and on the GEMS asset class. When most people talk about emerging markets, Bloomberg, pundits, they're usually often referring to the right side of the map, Asia, right? And that includes India. That part of of emerging markets basically holds about 2/3 of the benchmark, of the weight in the benchmark. If we go back 15, 20 years, emerging markets was much more evenly distributed across countries and almost across some asset classes. You still had more cyclicals like resources and financials, but it was much more evenly distributed. And in a world where there wasn't ETFs, buying a global emerging market fund made sense because you had exposure to a lot of the emerging market countries, which you couldn't buy yourself on, for example, Hargreaves Lansdown or any sort of the trading platforms back then. And also you had someone who understood which are the best companies, and gave you flavor of the largest benchmark names. Fast forward to today, as I said, the weights are much more uneven. And when you're investing in a global emerging market fund, any good portfolio gem manager will beat the benchmark by giving you exposure to Asia. They have to call Asia and China correctly. That's not to say that you shouldn't be investing in Asia or China, but you're not. When you invest in EM, you're not getting exposure to the other regions. Obviously, the other regions to the far left of the map is Latin America, which is essentially Brazil and Mexico. Two large countries. They benefit from the close proximity to the U.S., although maybe now the lay of the land is a little bit more difficult. But nonetheless, there's the opportunity. Now, if we talk about EMEA itself, the first thing you see that it spans across 3 different continents. And within those particular markets, you have different demographics, you have different cultures, you have different economic drivers, you even have different debt levels. So if we look at emerging Europe, you remember Greece back in post global financial crisis. Now it's one of the darlings of Europe, especially the banking system. Poland benefits from a very high educated workforce, high productivity rates. Poland is essentially becoming a developed market in terms of wage levels and productivity, but you have an aging population, and so there's already within that particular region is a lot more diversification. If you go across to the Middle East, you have a very young population instead of an aging population. You have good education levels, but not necessarily high productivity levels, and the debt levels are fine. They're able to finance their deficits. They have large reserves, and obviously the resource-rich countries can benefit and leverage on that. The benefit of those particular countries is that now they're really focusing much more on developing the society, attracting more expats, attracting and creating the ability to actually grow the economies beyond just the oil wealth. Turkey is a very important part of the region. It really straddles and takes the benefits of both. It has a high productivity rates, high education levels, but has a very young population. Yes, the debt levels are sort of volatile and the politics is very volatile, but that's emerging markets, and we'll get through into sort of how do we mitigate some of that top-down volatility across it. So just to give you a flavor of the markets, here are the sort of the markets across some of the major markets that we have. Really want to stress here is that what we're trying to do is have a positive net asset value growth, right? And what we found over the last 4 years and even over the last 10 years as we evolved investing into emerging markets is the ability for us to actually capture growth and alpha in return, alpha, which is positive relative performance, by investing in actually below the benchmark names. Because often these large benchmark names in emerging markets, whether it's EMEA or across any other emerging market, are often government related, often cyclical, bureaucratic, very little growth. Yes, you have high dividends in some of them, but not necessarily what you're going to actually do to grow to grow your NAV. The other thing is, I think now that we have ETFs, us as active managers, our ability and our service to our investors and our clients has to be much more specific to the growth and the positive returns that we're generating on a net asset value basis. Yes, we also pay a dividend, and I'll talk through that. But really, our focus now becoming on gaining bigger weights and putting bigger bets on the investments that we feel that we have a high conviction in. So within EMEA itself, so there's a lot of EM investment trust. Often they're Asia, ASEAN, or global emerging markets, which I said most of them are much more of a reflection of what's happening in Asia, and obviously Asia has its own unique investment opportunities. But within EMEA itself, we're one of the only investment trusts that exists, especially after what happened in Russia in 2022, where some of our competitors have either evolved or kind of stepped aside and stepped away from emerging markets. One last thing about EMEA and the opportunity within EMEA, what we found is as the weight of Asia continued to consistently increase within the global emerging market benchmark, a lot of the resources, a lot of the research from the investment banks naturally gravitated towards Asia. That's not to say that some of the large benchmark names are not covered by the investment banks; they still are. But we find there's a lot more opportunity now in EMEA because there's a greater ability to actually exploit some of the inefficiencies. Also, most of these markets, whether it's Poland, whether it's the Gulf countries in the Middle East, whether it's South Africa or Turkey, a lot of the liquidity within those markets, which are very liquid, is domestically generated. So you kind of have to understand, for example, what the Polish pension funds are doing and what they're going to do within their own market, because their mandate is to own almost 90% of their portfolio within the Polish market. So you have to understand where the locals are or what the locals are thinking. In the GCC, it's sovereign wealth funds, it's high net worth individuals, and even now there's a much more institutional mandate that's there. In South Africa, for example, it's very much a UK asset management industry that runs it, and they are much more sort of domestically focused, but also outwardly looking. So they're happy to move away from some South Africa if need be, or they see opportunity there. Not 100%, but they have much more flexibility. Now, we talked about EMEA and the benefits of EMEA and how that trust kind of why sort of if you want emerging market exposure, why you want to be looking at different components of emerging markets. Within EMEA and how EMEA and the trust will sit within a wider portfolio, whether it's your overall portfolio or whether it's your emerging market portfolio, is that within EMEA, you have much lower correlation to China. So if a lot of people want to sort of, for example, China's done very well this year, and they have the exposure, and they say, okay, I'm going to bet on the active manager in China, or I'm going to bet on the active manager in Asia or India for that matter. Can I gain some exposure anywhere else across the emerging market space, whether it's LATAM or EMEA? With EMEA, we have very low correlation to China, and we have very low correlation to the rest of the emerging market regions. So we kind of sit in our own bucket. As you can see, that correlation's come down. That's because Russia used to be in the benchmark. We're still lower correlation than most, but Russia used to be in the benchmark, and Russia was a large resource oil play and metals and metals, and so that obviously correlated to what China's demand was. I think those lines are also starting to change, and that evolution of what energy actually is defined as and how you use energy and certain industrial and precious metals. That also, I think the correlation would have been reduced, but probably not as much as it is now. But from today, we really have a lot low correlation. Now, the natural question is, well, what happens if Russia comes back? Are your correlations going to be massively higher? I don't think so, because also those distribution lines have already sort of been readjusted, and China still continues today, buy Russian oil and metals as we speak. But really, the objective of this slide is to show that actually we can also offer further diversification within a global portfolio, a wider portfolio of public assets versus private assets, or even within an EM portfolio to be specific, over and above the diversification that you get within the EMEA region itself, where you have different countries and completely different drivers between South Africa, the Middle East, and then emerging Europe. Just to give you sort of flavor and what I wanted to sort of what I highlighted earlier, our focus is to grow the NAV. Our focus is to deliver positive returns for our shareholders. And I think as now in the world of ETFs, we are as active managers need to do a better job of actually continuing to deliver on that. So yes, we outperform the benchmark, but really for most, what I found speaking to most shareholders is that when they buy something, well, how much did I make that 1 year, or how much did I make that 3 years on the share price of the trust, and could I have put it somewhere else, whether it's EM Latam, EM Asia, or EM, and this is the cumulative return. Now, obviously, against the DM, we're lower. That's because the Magnificent Seven, and it's very difficult. It's been very difficult. It would have been very difficult to outperformed the Magnificent Seven over the last 3 years, but that's not really our job either, right? So, and you're not going to hold 100% of the Magnificent Seven, even though you've done very well. But in a diversification and a portfolio context, this is something that we offer as a diversification variable. Okay, so our performance, I hinted around it. I talked about it a lot over the last 10 minutes. Here, basically showing that again, on an absolute returns, we're happy to show that we've outperformed and we delivered positive absolute performance 6 of the last 10 years. And 2 of those 4 years of negative returns were the pandemic and the Russia invasion in 2020 and 2022. And on a relative basis, we outperformed our benchmark, which is the EMEA benchmark, 7 out of the past 10 years. Now, it's important to remember, I'm showing you here is the calendar performance. The fiscal year for the trust is from September to September. But most clients and most shareholders and most prospective shareholders want to compare us to other investment funds and want to understand, how do we stack up against other investment trusts. So we put it in a calendar performance year, and we also put that net of fees. So that's after the fees. This is how much we generated in terms of performance. But just in case you wanted to look at it from a fiscal year perspective, this is the performance of the trust from a fiscal year perspective. Once again, it's net of fees. From a fiscal year perspective, we report up to July. And on a year-to-date basis, we're outperforming the benchmark, if that's what matters to you, but we're also delivering positive performance. I'm happy to report that actually we're even higher today, but obviously you'll see that as we report it. And if you look on Bloomberg and on any other websites, I'm sure you could see much better. The performance much closer to today than end of July. But again, this is to show everybody here the different performance, what we've been trying to do and what we're trying to evolve in. And for us and for myself and the rest of the team, the real focus here, like I said, is going to be the NAV. How do we do that? So how do you square the circle? How do you deliver positive performance? And how do you do that? For us, it's actually moving away from having such a large number of names in the portfolio, and having greater conviction portfolio. It's not a revolution, but more of an evolution. As we like the names, as we think there's opportunity here, we're going to continue to actually put a greater weight towards that. Obviously, we'd like to outperform every single year for the next 10 years. But for us, the objective is to continue to deliver. We're not going to be able to do that, but I'm sure the objective is to consistently deliver on our performance. We do pay a dividend. I'm happy to report that the dividend, we paid a dividend for the last 10 years, every single year, even when Russia happened in 2022. The dividend, as you can see, is somewhat more volatile, but it's still fairly consistent. Again, my objective and from the conversation that I've had, when you're buying something like in emerging markets, yes, the dividend is nice, but the first question is, have you delivered on the net asset values? Have you delivered positive growth? Have you grown my investments? And I think that's fair. And I think as active managers, that's what we could do. If you really wanted a yield, there's other income funds that you can, or trusts that you can invest in, or even just put it in cash in the bank account now, or in savings account. So For us, I think, and for me, and for the evolution of this trust is a greater focus on delivering on our active management policies and process that we've delivered on. And like I said, we've worked together now for over 15 years. Ale, my co-manager, has been with us for over 10 years. So we're a team that kind of understand how we work, we understand the region, and we have a much more understanding of where not only where the opportunity is, but more focused for us, and I believe this, and we can talk about a little bit more in the Q&A, is that there's always the first question should be how much we stand to make, but in emerging markets, it's how much do you stand to lose, right? What is your risk when you're putting the marginal dollar into an investment? And then from there, begin to evolve and understand what the direction of travel going forward is. That is, I believe, my presentation. There is a QIR code if you want the presentation yourself. You're welcome to download it. And yeah, James, please let me know if there's any questions.
There are some questions. Thank you. But do keep them coming, please. So I suppose that because of the nature of what you're doing, inevitably people worry about political risk.
Sure.
How do you factor that into your thinking?
100%. So look, political risk is a reality of investing in emerging markets, not just EMEA, but in EMEA, it's almost at another level up, right? We've had two wars, we had the pandemic, we had obviously Turkey's unorthodox monetary policy, and trying to move away from the top benchmark names, which are often very affected by the headline news, whether it's oil macro, whether it's the dollar, or whether it's political risk, reduces or mitigates some of that volatility, right? So what we're trying to do is two steps in terms of constructing the portfolio. The first is finding structural winners and well-managed companies. And I know that's easy to say because everybody says the same thing. But what we're trying to do here is you want to find the companies and the management team that have actually worked through at least one cycle, right? And what have they done? And so that reality, you know that the earnings growth and the value creation could come through if you have confidence in it. And so yes, there'll be volatility, but the volatility actually is reduced as we kind of invest in more higher quality names. And then over and above that, there are always sort of cyclical ideas and cyclical opportunities that present themselves when the headline risk is comes up. And so we try to actually capture that. So we don't want to be academic. We want to be very, very, very practical in terms of what we do. And political risk is very much a reality, but doesn't necessarily mean, and it's always often a risk, right? But it does present some opportunities, and we've managed to actually be opportunistic and practical about it so far.
Great, thank you. And they're kind of associated with that. How do you tackle currency risk?
So it's twofold, actually, kind of like more threefold. So the first thing is we all model every company that we have. So not sophisticated modeling, but we just need to understand what is the revenue, what is the cost, and is the currency possible. Now, just like oil, just like currency, just like gold, just like anything else in that's commoditized, it's a fool's game to try to say that I think it's going to be this in 5 years' time, right? So I have an idea of where the Turkish lira, for example, that's the biggest sort of volatility in our world. I have an idea where the Turkish lira should end so far this year, and also the market on Bloomberg can tell you kind of where they are. So you can kind of agree or disagree and move that. And because we know the market and we know what's happening, we kind of have a good idea of where we are in 2026, right? So we model our companies and understand the risk reward from that perspective, and how does that impact it over the next 2 years. We then also apply a higher risk premium on countries like that to figure out where is our risk reward. So like, if a company in Turkey gives me a 20% return in local currency, but I know that my risk premium is like 35, so that's pure, that's not really upside, right? And so right away, we that's not an investment opportunity. So we really kind of do those two things. The third is just kind of understanding where the market is, right? What are they thinking? Where could the lira go? What are the fixed income guys doing? That sort of thing. And that's again, we have to be as practical as possible in emerging markets.
Great, thank you. And then sort of last sort of big picture thing. Obviously, timing markets, this is something that people say you can't do, but do you try and use gearing or hold big cash raising sometimes, or do you use derivatives, or are there any things that you do to kind of control your market exposure?
Okay, so I have to be careful what I say, because it hasn't been sort of publicly disclosed yet. We used to use gearing.
Mhm.
We no longer use gearing because rates were so much higher and just didn't make sense, especially after Russia was out, and then the size and the impact on the NAV and the asset base. This is now something that we've considered, and it actually could be complementary once it's once it's finalized and disclosed. I think it could be actually quite enhancing to the way that we're trying to actually manage the fund
Okay, brilliant.
from a beta perspective. So we focus on alpha, we focus on the NAV possibility. But if there's a sort of massive beta rally, let's say oil price rallies,
Mhm.
yeah, am I going to go in and buy 5 petchem names in Saudi Arabia and Aramco, or do we use leverage to buy beta? So that's the kind of consideration that we're trying to think: is that possible? Is there an opportunity here over and above our borrowing cost?
Right, brilliant. Actually, there's a specific question here about whether you hold Aramco. Is it one of those big stocks that is just too big that it's not worth?
So yeah, so look, the trust is always underweight oil,
Mhm.
because I simply don't want to. I don't think there's that much opportunity in petchems, and it's been the right thing, and there's not much opportunity in Aramco, and we've been wall crossed many times in terms of trying to sort of think about, do we own Aramco in greater size, and yes, we hold it. We're always underweight, and it's always a question of how little do we hold it. And I, more and more, based on what I just said, is we should own less and less of the things that we don't think will go up. So less benchmark management, more active management in terms of absolute NAV production.
Great, thank you. Um, if you think about the sort of sector exposures, are they roughly the same in your area as they would be into the China-India bit of emerging?
Uh, Probably more focused on resources and banks.
Mhm.
So those are the two big things that we sort of always struggle with, or not struggle with, but those are the things that would impact our relative performance,
Mhm.
right? If these things sort of fly around, and whether up or on the downside. Like, to give you example, the banks and the financials are the largest component, much larger than resources. Well, not much larger, but if you combine oil and metals, it's sort of still smaller than financials. And within the financials, we counted there's about 67 investable names, right?
Mhm.
But we made most of our alpha with 5 names, right? And that goes to the idea that we're not buying the cycle or the sector. We want to make a bet on a financial play because we see there's an opportunity from a bottom-up perspective.
Okay, great. Um, Now, part of the thing that got China excited this year is DeepSeek. So, is there much of a kind of tech AI angle to what you do? Is there any exposure to that?
Yeah, so we own Naspers, which gives us the exposure to the China AI through Tencent.
Mhm.
We also in the Middle East, it's becoming the data center or the investments in data centers, but also in AI. There's several sort of companies that are working in the Middle East to again. There's a big shift in the Middle East to invest in the economy, and I'm not talking about NEOM or the Winter Olympics or the World Cup. I'm talking about digitalizing society,
Mhm.
right? So basically, what China did 10 years ago, right? Whether it's getting your driver's license, whether getting your new passport, or Deliveroo driver wants to sort of get a license, everything now is becoming digitized. And that infrastructure is really being built up, and the data centers and the joint ventures with OpenAI in the UAE, and a lot of the investments that are happening in Saudi Arabia. So those are the two angles where we're actually playing it.
Okay, great. Um, cool. All right. Um, you talk a bit about Greece. So Greece is one of these things that was never an emerging market, and it sort of then got downgraded. Has it turned itself
Yeah,
around now? There's a
yeah. I
silly
mean,
question about Alpha Bank, but I'm not so. Can ask you to.
Yeah, no, look. So yes, it's it's obviously become almost the darling of the financial sector across Europe, not just in EM, but also in DM Europe. And the political situation, again, you highlight the the politics in EM. It's on the right side, right? The PM wants this to work. They've worked very hard to take some of the bad debt and the bad assets that were sitting on the banks and moving it onto the government's balance sheet in order to allow the banks to finally become actually operational businesses. Alpha Bank is one of our largest holdings, for example, and that's done very well. But you have to remember, it didn't do that well last year, right? The other banks performed it well because again, operationally and the way that it was managed, this year was a much more reflective year of it. And so for us, active management matters, right? We owned more of the other two banks last year. We own more of this. We began buying it towards the end of last year, but that's so it's very much that's what we're trying to offer here, because I'm sure you can buy an ETF in EMEA, but what you're going to be holding is just basically the bad part of the benchmark.
Yeah, exactly, which you don't want to do.
Correct.
So actually, you talked about sort of investing below the sort of big stocks. How far down do you go? What's the kind of smallest market cap of things that you buy?
So for us, liquidity very much important, and that's something we kind of consistently discussed. In the past, it was less of it was there was more appetite for lower liquidity names. But in the past 15 years I've been working, illiquid stocks, no matter how good they are, can stay illiquid for a very long time, and therefore the unlocking of the value just never happens, right?
Mhm.
It's good on paper. They're very good management team. They deliver. There was, for example, if you looked at Kaspi in Kazakhstan, so a super app within Kazakhstan, very well run company, great growth over the last 10 years, but didn't do anything until it listed on the Nasdaq. And you went from a few $100,000 shares being traded on the LSE to 25 million, right? And then you right away you saw the unlocking of the value. People gave it credit, and so for me, we say as low as $5 million a day, but really the $10 million a day is really because the one thing that you're guaranteed in emerging markets is that something's going to go wrong, right? And when it goes wrong, you want to be able to get out, right? Yeah, and we make mistakes all the time, so we will be able to get, but we need to be able to get out, because if you can't get out, the liquidity dies, and then you just hold this position, and people are asking you about it, and you don't have an answer.
Yeah, exactly. Um, Now you mentioned Russia a couple of times when you talk about performance track record. So
Sure.
as far as I understand, you had some stuff that was invested in Russia and then suddenly
Yeah.
found you couldn't sell it anymore. And that's now still there in the portfolio, but valued at zero. Is that right?
Correct. So the performance that I showed everybody, that is with Russia included. So we didn't net that out. We took the performance hit in 2022, and we marked it all to zero. We had a lot of stranded assets. Some were so you separate the two. Some are sanctioned under the U.S.
Mhm.
sanctions, and some were not. Right. The stuff that were not, we were approached by individuals or companies that would allow us to actually take the cash out. And we have done that. Each particular transaction was specific to that transaction, with a lot of lawyers and a lot of legal hoops that we had to jump through. But let's say on average, we got about 20 to 25 cents on the dollar for those assets, right? And we repatriated everything that we could repatriate back, and paid it out as a dividend to the shareholders. The other assets that are sitting there, and I did have a slide, but then compliance told me that it's not necessarily public, so we couldn't put it together. But I'll give you a better idea of what it is. Those assets are sitting there. They're even collecting a dividend. So the cash of the dividend is going into what is called an S
Mhm.
account, and is sitting there. As of now, and as of today, the Kremlin says that we have ownership of those assets. They're just stranded and we can't take them out. Right? And if we decide to even if the Kremlin says, yeah, you can take them out, we can't actually take them out because the sanctions in the US won't let us to take them out either, because we'd be in violation of the sanctions if we actually profited
Mhm.
off them. But as of now, those assets are sitting there. They're collecting a dividend. Actually, some of them are growing. but we can't do anything with them for now.
Okay, so they're still valued at zero.
Still valued at zero,
Yeah,
correct? Yeah, yeah,
exactly.
still valued
Yeah,
zeros.
cool.
Yeah,
Okay. Um, there's a couple of specific country questions.
sure.
But
Yeah.
actually, to wrap it up, something bigger. So, obviously, one of the things that have been moving markets this year has been the American tariffs. So, to what
Yeah.
extent have they affected the things that you're investing in?
So I'm happy to report that actually EMEA in this instance it has a massive advantage. None of our countries are, except for South Africa and sort of the political noise around Elon Musk and the farmers. We are not impacted. This region is not impacted, at least not in any real aggressive way, to the tariffs. In fact, they've gotten sort of much more open their ability to actually invest in AI and get access to chips. Yes, there's security risks around it, but actually the region is, I don't want to say immune because you never know what happens and everything changes with Mr. Trump, but or President Trump. But for now, we are actually not impacted.
Hmm. But we've also seen, again, big picture stuff, weakening dollar, which is generally seen as good news for emerging markets. Do you agree with that?
Yes, yeah. So it's a weakening dollar. It is positive news for emerging markets. Obviously in South Africa, in emerging Europe, but in the Middle East, it's actually not necessarily as good, right? And for us, for example, the dollar impacts the performance of that region, that particular part of the region, more so than oil, right? Because oil feeds into the investment
Hmm.
into the private and the capital investments, but dollar actually reflects right away on where we are. And you could see it in Saudi Arabia, for example, where earnings are subdued, they're down, and so as the dollar comes off, so has the market.
Okay, fair enough. But one of the other things we've seen is a soaring gold price. Have you got exposure to that?
Yes. Yes. So through South Africa and actually through Saudi Arabia, it's sort of untouched land. There's a lot of opportunity here, but South Africa, and that's something. So again, so we have the structural stories and we have the cyclical stories. We started to buy gold early part of last year because it wasn't like, oh, I think gold is going to go to 3,000. No, it's that, okay, well, do I think gold is going to be at 20 lower than 2,200 here? No. Do the gold miners offer us yield? Yes. Do the gold miners have potential to kind of recover from their operational challenges? Yes. Where's the valuation? Okay, it makes sense on a risk reward basis. And we've owned, a big part of our performance this year has been banks, Greek banks, and gold, and our gold positioning.
Great, thank you. One technical question that we'd like to know the answer to. Um, when does things get upgraded from emerging to developing? And then what would you do if that happened?
Yeah. So look, that's I think the MSCI changes have been so sort of frequent now that I think for us as a we offer investments in those regions. And I think we'll continue to offer investments in those regions. And that's something that I'll be pushing the board on. Yes, MSCI calls it EM, calls it DM, but for me not to invest in Poland or for me to not invest in Saudi Arabia is not necessarily because this is what we offer. We offer a regional investment in this, and this is our expertise. So for us, it's much more focused on delivering growth within that particular region, giving the shareholders exposure to that region.
Good, thank you. So just to wrap up, two more questions, I think. So one is
Yeah.
basically, can you tell us a little bit of your view of Poland? And the other one is UAE, and especially about esports.
Uh,
Yeah,
Esports in the
yeah,
UAE. Okay, sure. All right. So look, Poland is a fantastic sort of economic success and economic story. Consistently delivering, consistently moving higher. The last 2 year, the election that we had 2 years ago really boosted it. You had Donald Tusk come through, and the politics were going in the right direction. Again, you highlight about the impact of that. And on an economic perspective, you have high productivity rates, lower inflation, high wage growth, an educated society. So it's done very well. The politics, again, rears ugly head, and in this instance, it's becoming more negative, right? So Tusk is losing his influence. The conservatives or the opposition is really sort of coming back, and we've seen high taxation, right? Like everywhere else in the world, the governments need to spend, and the fiscal sort of position is not necessarily supportive, right? I think that I am more negative on the banks. I think this taxation, once you give a politician the ability to tax, they're not going to stop and say, I'm going to go away. I think this is the first move, not the end. How more severe it becomes really depends on how the politics gets there. But we've basically de-risked our position. We've made a lot of money. We de-risked our position. There's still more opportunities in Poland, but not necessarily in the banks, because that will really reflect the investors' sentiment towards the country. On the UAE, so the UAE with two things. First, it's done phenomenally well this year, and it's almost the exact opposite of what Saudi Arabia is. It's still generated a positive return. A lot of that is actually, even though oil is down and the politics and the geopolitics that's happening around it, the earnings growth was there,
Mhm.
right? And also the quality of the management teams and the communication is much higher. So in emerging market context, you want to be in somewhere where you can actually understand what your risk reward is. And like I said, it's always important to figure out how much do you stand to lose first, because anybody can create upside, whether they're investors or they're not. So I think the UAE is on a path and on a trajectory that will continue to make it sort of an important part of the emerging market space. But it's done phenomenally well, and it's not going to escape reality,
Okay.
right? So there is going to be a sort of a moment where you have to consolidate and have to get a better understanding and figure out where the opportunity lies, whether it's AI or what have you. On the esports specific, it's becoming very specific to that. Yes, there's a lot of interest. Yes, there's a lot of investment, but from a public perspective, there isn't really anything, and we don't do
Yeah.
private investments. We considered it, but like I said, I prefer to be liquid, and I prefer to get out when things go wrong.
Brilliant. Thank you very much. You covered a lot of ground. Thanks for answering all the questions as well. It's really helpful. And I do hope people go and have a look at the fund, because I do think it's interesting. Yeah,
Absolutely.
great.
All right. Thanks, guys.
Thank you.
Thank you for having me on.
So
Thank you.
thank you
Cheers.
for your time today, and we will be back next week. Have a good weekend.